Um, Maybe you got a letter recently. Like I've been telling you, if you get one, cash out of the pension, take whatever losses they provide you to cash out early and get the hell out of there. Take the settlement offer. And take some of that money and go buy some precious metals while you can. And I need to give a special shout out, much deserved, to sdbullion.com, Silver Doctors. sdbullion.com. They have a special right now with shipping $7.77, no matter the size of the order, with extremely low premiums on like buffaloes and no name silver rounds, things like that, as well as your typical eagles and other things. But got to give a shout out. They deserve it. Got my silver through them recently for the game show. Fantastic. The link to their site, if you want to follow that one specifically, in the description box below. If you feel like buying some silver right now, that will let them know old JSnip4 sent you, because they sponsored my game show channel while it lasted, and I want to give them a big thank you back. So if anybody's in the mood for buying silver right now, whatever the size order, use the link below in the description box to go buy it, because they'll be able to track it. That's all I'm saying. Appreciate that. Thank you. Sorry for having to say that in the beginning of my video and not getting straight into the video. But it kind of goes hand in hand. Pension funds, big problems, which I'm about to read you. Sorry, was this Dallas? Dallas, yeah. Sorry about your luck. Homeowners, citizens of Dallas, sorry about your luck. Pensioners, you get that damn letter in the mail, you get a call, have a meeting, we got problems. When you first hear that word, problems with the pension, you reach out to them. Can I settle with you right now? Is there any chance I could just take a smaller lump sum and just get the hell out of there? Maybe they'll say yes. And if they do, you take the money and run and buy some silver. Dallas, this is from Zero Hedge. Dallas pension fund panic as mayor warns of 130% property tax hike to avoid collapse. You sorry schmuck citizen, taxpayer, excuse me. We effed up. We cooked the books. We lied through our teeth. And we ain't got no money in that pension fund. But the law states we have to fund it. And by God, we're going to fund it. 130% property tax increase coming to a city near you. Dallas, Texas. Oops. Sorry. Over the past year, the biggest casualty to emerge as a result of global near or negative, interest rate 0% interest rates, again, or close to it, monetary policy have been pension funds, right? So the biggest casualty to emerge as a result of this practice is the pension funds. I've been over this with you numerous times, and I'm here to tell you right now, I have never, ever, ever in my life, or the last 6 years of doing YouTube videos, came out here and mentioned problems with the pension funds, more problems with the pension funds, got another problem with this pension fund, like I have been in the year 2016. I have never done these videos in this quantity. Different ones. I'm not reading you the same article. I'm not going back. I got 2,000 something videos on freaking YouTube. You know how you turn the TV on? Oh, I already saw that episode. I'll watch it again, I guess. Nah, I really don't want to. What else is on TV? I'm not re-uploading my videos, in case you didn't catch that. These are all new videos. Every day I do a new video. And it pains me, actually, to say, I see the headline. That's what my whole body does when I see it. I'm, browsing my sites for the day, see what kind of news I want to read. Not that I want to read. What kind of news I am going to read, regardless of whether I like it or not, I'm reading it. I want to stay informed, and I want to keep you informed. So that's why I do it. I'm just going, that's a decent, yeah, I don't want to do that story. Oh, pension fund. Property tax, 130, And I feel everybody's pain. I see the headline, oh, man, that hurts. Oh, damn, 130. Well, at least I'm in Florida. I don't have to worry about that. Or do I have to worry about that when it comes time for everyone to really take a fine-tooth comb to the pension system in Florida or Georgia or New York or wherever the hell else in the country? You know why? Because they all practice the same crap. On paper, we're looking okay. We're mostly funded or we're fully funded as long as we get 8% return. Last year we didn't get it. The year before last we didn't get it. And so far this year we're not getting it. So you're going to have to change your model. Your model says it's okay with 8% returns. And we're talking billions and billions and billions and billions and billions of dollars. So a 0.5% changes things quite a bit. A full percent is absolutely devastating. So when you recalculate, like I said before, recalculating route, recalculating pension. And it does not look good. Recalculating it higher? We're doing 9%? No. 9%. Get out. What are you, some kind of comedian? Get out of town. That's hilarious. No, more like 6 or 7%. Which means we're now massively underfunded if this continues. And it has been continuing, so, there's that. Over the past year, again, the biggest casualty is to pension funds is the negative or near interest rates, near 0% interest rates. In August, we created the chart below as a simplistic illustration of the pension duration dilemma. The chart graphs how a pension liability grows in a declining interest rate environment. I'm going to show you this in a second. Or in fact, no, yeah, give me a second. I'll show it to you in a second. The chart graphs how a pension liability grows in a declining interest rate environment versus the value of 5-year and 30-year Treasury bonds. As you can see, a $1 billion pension that is fully funded at prevailing interest rates would be nearly $700 million underfunded if interest rates declined 300 basis points, which essentially would be like 3%. And all of their assets were invested in, let me start over. As you can see, a $1 billion pension fund is fully funded at prevailing interest rates would be nearly 700 million underfunded if interest rates declined 300 basis points and all of their assets were invested in 30-year Treasury bonds. The result is obviously even worse if the fund's assets are invested in shorter term duration 5-year Treasuries. So here's this chart. Let's take a peek at that. As interest rates rise, it says, the present value of the longer dated pension obligations does shrink. That says convexity ensures that the duration gap between assets and liabilities converge in a rising rate environment, so the benefit of rising rates will always be eclipsed by the detriment of falling rates. As interest rates decline, the present value of the longer dated pension obligations grow faster than a pension's shorter duration assets. So even if asset returns are positive, the underfunded status of a pension can balloon due to the longer duration of their liability stream. Okay? So what do pension fund managers do when perpetually declining interest rates continue to drive their funded status lower and lower despite one's return profile? Well, there's little choice. One has to move further and further out the yield curve in an attempt to match asset duration with that of one's liabilities. That or reach for the skies by buying the riskiest assets possible and pray for a home run. And you know old J step 4 and prayer and hope. Unfortunately, most pension fund managers, better known as dumb money, are hardly star stock pickers. One such example is the fast imploding Dallas Police and Fire Pension, which covers nearly 10,000 police and firefighters, and whose troubles we first covered back in August, and naturally Jason 4 relayed that information to you, is on the verge of collapse as its board and the city of Dallas struggle to pitch benefit cuts to save the plan from complete failure. So guess what? Dallas fire and police guys, take JSNP's 4 advice when they tell you we'll settle for this amount before it's all gone. Take the money and run into precious metals. According to the National Real Estate Investor, the Dallas Fund, the Dallas Police and Fire Pension, which is actually DPFP, okay, was once applauded for its diverse investment portfolio, but turns out it may have all been a fraud, as the pension former real estate investment manager, CDK Realty Advisors, was raided by the FBI in April 2016, and the fund was subsequently forced to mark down their entire real estate book by 32%, thereby exposing just how great the risk truly is when pension funds swing for the fence. Give me that yield, give me that interest rate. Swing, batter, hey, batter, swing. Oh, missed that one, 32%. Oh, that's going to hurt. And if I'm on the other end, you're managing my pension fund, I'm ready to kill you. 32%, we have to write down this book. Well, real estate was rising. Real estate. We didn't force you to give us your money, We didn't force you. We didn't put a gun to your head and tell you to put your money in our fund. We're trying to do our job. It's a tough market. We tried to put it in such and such. It amazes me that all these pensions, every freaking one of them, is absolutely relying on and attached like a freaking boat anchor to 8%. We must average 8% for this long period of time. We can have some down years and we can have some really good years, but we need 8%. Except when we're in the down years and we already got people collecting on that pension and they're sucking it dry. And our yield sucks on the investment. In those cases, we got to find some alternative money. Hence, the 130% increase in property taxes. Do you think the citizens, if given a vote, citizens, there's 10,000 police and firemen that are on the pension, that are in this pension system. Are you okay with us raising your property taxes 130% to save those guys? They deserve their pension. The average person is going to say, who in the F is saving me? I've got $1,100 a month freaking healthcare bill, which is like a second mortgage, on top of my real mortgage, which, by the way, I'm behind on. I've got credit cards, some of them maxed out. My kids, such and such. Groceries, such and such. Are you kidding me? That's what the average person would say. They're not going to say, oh, we love our police and firemen. Thanks for doing a good job all these years. I'll gladly bend over and take one for you guys. 30% increase in my... That's what 130% is, a 30% increase, you could say, right? On top of whatever you're paying. Oh, you pay $2,000 a month? A year for property tax? 30%. Well, what's 30% of 1,000? $300. What's 30% of 2,000? Another $300. Your $2,000 a year taxes for your house, property taxes, just went up to $2,600. Boop, thank you. And you know what? But wait, there's more. Oh yeah? Jay Snip, you're killing me already. What else is there? Oh, there's more. That's to try to get it back on track. And then what happens if, we fired that realty investor company, KDC Realty Advisors. We hired another pension system fund manager or, group, whatever. Got a better track record. They said it. They showed me the charts. They've been doing pretty good. But they don't do what they need to do. And the numbers that you thought you were going to get, interest rate return, you're not getting them. And then was it the mayor? Mayor. Guys. I know you wanted to kill me before. 130%. I don't know what else to do because I'm a mayor. I don't have state funds. I can't put a backdoor tax somewhere and let you guys not know that it's actually to fund the pensions. I can't do that. I got to be brutally honest. And there's only one source that this mayor right here can get from you guys, and that's property tax. We could raise license fees and things of that nature, but it's really the property tax. And I know we raised it 130% before. I got to raise it again. Oh, and before I tell you the number, and guys, if you're not sitting down, please sit down. This is Mayor Jason Ford speaking. We raised it 130% before. This is going to be the equivalent of about 160%. If we did it the first time, it would have been, what you're about to see is about 160%. And I got to go even higher than that, so it's going to be about 180%. And the reason is the pension fund's doing not as good as we thought, but it's actually not getting any worse. The problem is the property values have now come back down to reality again. So when we raised your property taxes before, and now we're going to raise them again, if the property values were where they were before, 160% right now would be okay. We could raise it that high. But because the values of your houses went down, we got to raise it to 180% right now to make up the difference. I hope you understand. Firefighters and the police, thank you. And I'm going to tell you how much they thank you. A little while back, I was doing a pension video, and I was pissed off, as you probably were too, as I was reading it. And this was about California, but not just them. It happens everywhere, I've been told. But this story was about California, and police officers are doing it, firefighters are doing it, the freaking chief of police is doing it, the fire captain's doing it. Okay, just to give you an idea, everybody's doing it. And when I'm talking about doing it, they have this incredible system in place. This is unbelievable. If you hadn't heard before, or if I'm about to remind you, this is unbelievable. You make $100,000 a year as a lieutenant with the police department or fire, any of these, doesn't matter. Bottom line is, you're a pensioner working for the city in some capacity, police, fire, whatever. You make $100,000. That's your final salary as you're leaving. You've been there for 18, 20, whatever, 20 years. You didn't make $100,000 to begin with, but you do now that you're leaving, okay? That was your final year's salary, just like the year before. Maybe you got a little 2% raise, whatever. You're at $100,000 for 2016, and I'm retiring at the end of 2016. They've got this fantastic rule system where you, knowing this rule in advance, I'm going to save up all my vacation days in 2016. I'm going to save up all my sick leave for 2016. I'm going to do all the overtime, all the side work, all the extra income I can possibly get in 2016 before I retire. So that when I do retire at the end of 2016, they take my final salary for the year and base my pension off of it. So my $100,000 a year that I should be getting back in pension, I could get $130,000, $150,000, possibly $180,000 if I can play this just right in my last year. As in my new yearly salary for my pension. Not a lump sum. $130,000, $150,000, $180,000 a year in the pension being paid to you. So, and I'm sorry if I offend any law enforcement out there or fire guys, rescue, okay? As you know, I used to volunteer for the sheriff's office as a volunteer. No law enforcement, no gun, no police powers, just helping out, okay? Helping out at accident sites, traffic light out, basic stuff. Get out there, have a little partner. We're chilling, talking about our day, Fridays, going out, doing our thing. Felt good to give back to the community, okay? But forgive me if I don't feel bad for you because the pension system is imploding on itself and you people are gaming the living crap out of the system on your final year. And you don't get to have your $150,000 or $180,000 a year salary when you should have had a $100,000 a year salary. Forgive me if I'm not upset at all. And when the people of Dallas find out our property taxes are going up 130%, oh, and by the way, these police and fire guys, how much do you want to bet they're doing the same thing there? Which means there's even more, much more of a burden on the pension system. And when I'm telling you, they rely on the 8% thing, and we got our models that show we'll be funded fully as long as we can keep 8% and out, yada, yada. That model does not ever, even kind of, anywhere in that model does it say every single pension employee when they retire is going to do the old magic trick maneuver on the last year that they work, extra overtime, extra vacation days, and cash it all in so that we can pay them 20, 30, 50, whatever percent more of their pension than we normally would have. That's not cooked into the model, guys. I'm sorry. So how much more of a burden is that putting on the system? And then they're going to have the nerve to tell you and me, regular old citizens, we need to raise your property tax, sucker. Yeah, but I can't pay. And as soon as they say that, my sister comes running out. Nobody said life was fair. Nobody said life is even. Love my sister. Oh, I love my sister. Sheep. Oh. Nobody said, Edger, Dad and I are talking about the bankers. They stole the freaking money from us. This TARP funds, Federal Reserve gave them trillions, gave Morgan Stanley's 2 top executives' wives millions of dollars each to go invest in the student loan debt. And the way the contract was written, I did a video on this a few years ago. I'll never forget it. The way the contract was written, if they lose on their bets with the money that they took, these 2 wives, taxpayer will take care of it. If they are profitable in their endeavor of going for certain high risk, student loan debt type stuff, not necessarily high risk, it's low risk because you're going to get your money, right? You got to get it, so you got to pay it. But doesn't mean you're going to start paying now. You can tell them, yeah, I owe the money. I'll see you in 20 years when I can get the money. So if they lost the bet and didn't make any profit, taxpayers are on the hook. If they do make profit, it's all theirs. This is a special deal from the Federal Reserve to, I believe it was Morgan Stanley, top 2 executives' wives. Wouldn't you like to just know someone who could give you, at near zero interest rate, again, a pile of money? Millions and millions and millions these women got. I want to say it was in the 20 million something each, if I remember. And then you can go do anything you want with it. So think about that. You could park it somewhere and get, call it 1% interest somewhere. But you only had, at the time, wasn't it a quarter? Interest rates were 1/4%. So 25% of 1%, right? 1/4%. I owe monthly payments back to the Federal Reserve for $25 million, like you'd expect monthly, at 0.25% interest. But I'm making 1 full percent interest, which means I'm profiting 0.75% of interest. That sounds fantastic. I don't have to do anything. I don't have to start a business. I don't have to get capital. No, we're giving you the capital. We're giving you the capital. Do what you want with it. Just pay us back the 1/4% while you're raking in a full percent. And again, they're investing in types of loans that people have to pay. You can't bankrupt out of a loan like this, right? So naturally, you probably pick some. Let's say they picked a bundle of them that were paying. Not the bundle who aren't paying. We don't want those guys. The ones who are paying. How much is student loans, the debt, the interest? They're not 1 or 2 or 3 or 4%. They are multiples of percents. And God freaking help you if you miss some payments, you get behind. I'm sorry, Mrs. Smith. Subsection C of the contract states that if you miss any payments, the rate goes up automatically. I'd like to fix that for you. I know you made a mistake, but it's all built into the system and I can't change it. Oh, of course you can't change it because now they're locked in at a higher interest rate for the rest of their stinking life. So, again, forgive me if I don't give a crap about your pension system, about you getting, well, it's mine and I need it now, says J.G. Wentworth. My money and I need it now. Where's he been anyway? J.G., where you been? I have a feeling J.G. may have been buying up some pensions from people. I do have a structured payment. I'm collecting it now. It's a pension. Oh, really? we'll give you 50% of it up front, all in one lump sum, if you let us take over the payments to us. Okay, I'll do it. I just need, again, it's my money and I need it now. I'll do it. And then J.G. Wentworth happened to get a pension system that had to get restructured. And now J.G. Wentworth is in deep trouble. But you got out of it. You got out of it in time. That would be a funny, hysterical story if it were true. I don't know that it's true or not. But I sure as hell haven't seen J.G. Wentworth commercials in a long time. So what happened to J.G. Wentworth? J.G., are you out? Are you in trouble? So, anyways, I'm done with this video. I've said enough. The pension systems are going to be imploding. And as you can see, their first reaction, suck off the people as soon as possible. The mayor, we've got to raise property taxes. How about no? How about you just rewrite the law like you always do? Oh, law says this. It's ours. It's ours. It's guaranteed. Oh, we're going to have a session today. Guys, let's rewrite the law. No longer is it mandatory. Have a nice day. Now you guys want to talk about pensions? You want to settle? Yeah, actually we do want to settle. And there's been times when they decided, no, we're not going to settle. You're asking for too much of a haircut. We're going to go all the way. And they even replied back to the lawyer representing the pension system. I don't remember which one this was. You're probably going to get nothing in court. You realize that. If this goes to court, you're probably not going to get anything. We don't care. We think we can do it. We're going to do it. And like he said, sorry, the money's not there. It's null and void. It's bankrupt. It's gone. Judge ruled just as the guy said it would. You should have taken the freaking haircut, you idiot. And they didn't. Sorry about their luck. I'm JSnip4, and I hope you're staying informed. Again, I wish I could come out here and say, hey, guys, there is a pension fund that has been wrecking it, killing it. These firefighters and police, they're going to do the old whoop-de-doo maneuver at the end of their last year. And it's okay because there's plenty of money in this pension. Good for the police and good for the firefighters. Matter of fact, take advantage. Do it. But there's not a chance. You realize, you know there's not a chance in hell that's going to happen. There's not a chance in hell that you're going to hear a story about a pension that's just flooded with cash and doing fantastic. Save it. Take care.